We're delighted to have you with us today as we get you practically ready for the upcoming lease accounting changes taking effect from the 1st of January 2026. Here is what we will cover today. So we're going to be going through the key changes and what they mean for your finance team and your business, some practical tips to prepare smoothly and confidently, the common pitfalls to watch out for, and how CCH Tagetik can help you manage leases easily, effectively and compliantly. We'll now move into our live Q&A session, so please do submit your questions throughout using the question box on your screen, and we'll address as many as we can during the session. And then we'll finish up with a few practical next steps to make sure you're ready well ahead of the deadline. So before we get started today, I'm delighted to introduce our speakers. First up, we have Nick Kenderdine, CEO of HAYNE Solutions. Nick is a qualified accountant with over 35 years post-qualification experience, having worked across finance, IT, and change-focused roles in a wide range of sectors. He's been working with CPM Solutions since 2008, including Tagetik since 2018. And joining Nick today is Chris James, Solutions Delivery Manager for CCH Tagetik. Chris is an Associate Director in the Northern Europe Centre of Excellence with over 14 years experience across finance and CPM, and he's been focused on IFRS 16 in the UK and Ireland since 2018. Now, without further ado, I'll hand over to Nick to kickstart today's masterclass. Over to you, Nick.
Okay, thanks a lot. Well, welcome everybody. Before we dive into the masterclass itself, just like to understand where everyone's sitting with their knowledge on leases. So we're just going to run a quick poll just to get a sense of where you all are at, and hopefully by the end of the session you'll be a bit further advanced. So if you'd like to interact with the poll and select one of the answers to understand where you're currently at. Thank you. Okay, excellent. Well, not surprised that there's no one in the very well. I feel confident in applying them. They probably wouldn't want to be here today. Also really glad that people understand the basics, because I don't want to take you through the step-by-step basics of what's happening, but it's more getting a sense of how can you start getting ready for these changes. They're coming. Give you a few tips and tricks, and maybe highlight a few areas not thought of that you may be needing to do. And yeah, some of you finding them confusing. Again, hopefully this will give more clarity and move you up the scale. So thank you for contributing to that. And I think now it's time to move on and start having a scene set, which I'll take you through where we are now, current scenario. And basically, up until next year, you've been able to treat your leases as an expense. You account for them in line with the payments you're making. You take them to an expense line which sits above your EBITDA as an operating expense. And there's been distinctions between operating and financial leases that you've been able to take advantage of. There has also been the option under FRS 101 to account for leases on your balance sheet if you decided that's what you wanted to do. Now, some businesses have taken that opportunity, but it's not been many. But if you have been doing that, then because of the similarities between IFRS 16 and the FRS 102 changes, you can continue to use that methodology. It's still applicable, and you'll probably have fallen into the top category of knowing all about it. So I suspect that doesn't apply to many on the call today. So that's the current scenario. Let's move on to what's changing. Well, you're going to have to recognise almost all leases on your balance sheet. Recognise them as right of use assets. Create equal and opposite liabilities and assets. Make sure that the assets you're using are shown in your balance sheet. The intent is to ensure that businesses are comparable with each other. So it strips out where people are using effectively off balance sheet financing for their assets to draw their business compared to those that are fully accounting for them. And you're going to need to calculate the interest charges and separate those out from the actual lease costs on there. What else is happening? There's going to be no de minimis level set under FRS 102. Under IFRS, leases under £5,000 you can effectively ignore for the changes. Under FRS 102, there is no set limit. Now, that could be a good thing, could be a bad thing. The upside is you can negotiate with your accountants what your de minimis level is. So it may be that you say for your business, it's £10,000 and we just continue to account for them as they are. It could be it's 2,000. It's up to each business to define with their auditors and agree with their auditors what is going to be impacted and what isn't. So it does give you that flexibility. You can also ignore leases that are less than a year for obvious reasons. If it's less than a year within your accounting period, you're going to fully expense it anyway. And you can calculate the interest. There's slightly more flexibility under FRS 102 that you can use the rate that's applicable in the market rather than necessarily using the weighted average cost of capital that IFRS 16 looks for. So there are elements of flexibility in the new rules that are coming in that you may want to take advantage of. So it may make it slightly less onerous than IFRS 16 was. Okay. One other area that you may not have thought of and you should take account of is there are instances of embedded leases. So it's not just your lease estate you need to be worrying about. You also need to start looking at service contracts you may have. So a couple there that we've got is if you've got a lot of shredding you need to do for your business, and there's a service contract where the service provider has a shredder nominated for your business because of the volumes, then actually that's an embedded lease. And you need to start thinking of how you pick that out of the contract. Similarly with cleaning, if you've got a cleaning contract, for example, if you're a shopping mall and you have a service contract with a provider that actually has a dedicated polishing machine costing £5,000, that becomes another embedded lease. So not only do you need to start thinking about your lease contracts, how they are, you also need to start thinking about, are there any embedded leases that we need to take account of? So it becomes slightly more complex. Again, conversations with your accountants, your auditors may shed some more light on what they're expecting you to account for here. And it isn't a one size fits all. It is business by business conversations that you'll need to have. Okay. So the change to your postings alluded to earlier. Instead of just putting your costs through as they're incurred, you're going to want to now, or you're going to have to start splitting out the leases onto your balance sheet. You're going to have an asset, an equal and opposite liability. So you depreciate the asset when you make the payment on a monthly basis. You then have to write down your liability on the balance sheet and the account for the interest below the line. But the key bit of this is it's all coming below the line. So no longer are these costs sitting EBITDA, which for some businesses, certainly if your valuation of the business is on EBITDA basis, then this is a benefit because effectively you're increasing the hopefully increasing the profit or reducing the loss that you're showing at EBITDA level. And again, that then impacts on how the business is valued, because once you put your multiple in, it's hitting below EBITDA. Okay. On transition, unlike IFRS 16, there are no transition adjustments required. You don't have to disclose the impact on prior periods. There's no accounting for prior period adjustments, and that will help, but it does mean from the 1st of January you have to start accounting for your lease estate from that period onwards. And whilst it's easy to sit there and think, actually, oh, well, I don't report until 31st of December 2026, and that's when it is. You probably want to start reporting on your monthly management accounts. So it's not just a case of, oh yeah, we can wait till the end of the year and just do a high level adjustment, because it will fundamentally change the way your profit's stated, certainly EBITDA level. For those, and mentioned earlier, if anyone has been doing under IFRS 16, then you can continue with those adjustments as you've been previously calculating them. The rules, regulations, guidance is that IFRS 16 is a good approximation, probably a better approximation in certain people's areas or eyes than the FRS 102. But although you say their preparation tip, although your prior period restatement isn't required, you still should look at your opening balances and make sure you've got documentation around your whole lease estate for the auditors, because that is when you will start having the discussions with them around there. Okay, thank you. So business benefits. We've talked about improving EBITDA. Lease cost is shifted below EBITDA level. That will help with evaluations. For investors, you're going to have a clearer liabilities. Your balance sheet is reflecting your true lease commitments and your ongoing commitments at the moment. There is no long-term commitment recognised in your accounts unless you make a note to the accounts. It means that you've got consistent reporting between businesses, and you're then going to start collecting data on leases. Now, that might sound onerous, but what this will do is start helping you to understand the whole of your lease estate, and that may open up opportunities on the procurement side. You may have leases split across multiple providers, that actually you can get a better deal if you go to one or two providers in the market and rationalize your lease estate. So it will start giving you visibility across the business or your group of how many leases you've got, who the providers are, what the tail is for how long you got left, etc. So that is a definite benefit. And you always say, if you've improved your EBITDA, if you've improved your valuations, why wouldn't you do it? And why haven't you been doing it for years, you know? And a lot of that is around data and understanding that, yeah, accounting teams are busy enough as it is without having to do additional things, but this one is no longer optional. You have to be doing it. Okay, which moves on to the pitfalls. So firstly, you're increasing your declared liabilities assets. It's impacting your balance sheet. Now, the impact of this is it's going to impact into your ratios that you use to evaluate the business. So your interest cover, your gearing, your return on your assets employed, return on capital employed, all of which, because your liabilities assets are going up, are going to be impacted. And this in turn may then impact banking covenants you have in place. So if you have a covenant where you cannot drop below a certain level of return on assets, return on capital employed, because your denominator is increasing, this may impact your covenants and may make you technically in breach. So again, understanding your estate, understanding as soon as possible what your impact is going to be on the business, allows you to start conversations with your banks and maybe look at adjusting the covenants to take into account the changes in lease accounting. You know, it's a conversation that you probably want to be having as soon as possible, rather than coming to the end of the year and making an adjustment and all of a sudden finding that you've breached covenants and loans are being called in. Other impact, increased audit time and fees, especially your initial years. If you're using one of the big four, then they have been dealing with an awful lot of IFRS businesses, so they will have a really good understanding. However, if you're using smaller accountants, maybe more local accountants, regional accountants, they may not have had as much exposure to this. So the conversations may be more in depth as they build their learning, as you build your learning. So as always, the longer the conversations, the higher the fees. People never do anything for nothing. They're not charities. So I'm sure they're quite willing to tell people. So avoid that. And the temptation of accountants, being an accountant myself, I know Excel, it's the answer to everything. You know, it's great. We can just go and calculate that in Excel. Well, yes, you can go and calculate in Excel, but it's leads into potential Excel hell, which is always a scenario we see on CPM solutions. But certainly on lease accounting, it's great. You can go away, you can get one of your team that's a very proficient Excel jockey to go in and build you a model that works, and that's great, and it will work for the first year, and while the person is there with the business, not a problem, because they understand the model. They can explain it to the auditors, and they can explain it this year, and they can explain it next year, and the year after, and the year after, and it just keeps, as auditors change their audit teams as well, it means you constantly have the fees and the conversations to talk about how you audit your Excel sheet. Are there any formula errors? Is it consistent across all your leases, etc.? And that's before your key person moves on, gets promoted, and they're no longer doing the spreadsheet jockeying for that part of the business, or they've left the business and they do a handover. And as always with handovers, if you get 75% of the knowledge handed over, that's brilliant. But still 25% of the knowledge that's gone, and into your second and third handovers, you're down to 50% of the knowledge of why the spreadsheet was built this way. And it becomes more and more of an issue. Interestingly, anecdotally, when we moved to IFRS 16, we saw a big uptake as early adopters. And we had an awful lot of early adopters, that's great, but we had an awful lot of people that said, you know what, we can do this in Excel, we don't need to invest in a system, with no problem at all. And that led to a second peak, when after 12 or 18 months, we started to see a lot more businesses coming to saying, well, we've tried this in Excel, it's a nightmare. You know, there's so much data. And if you've got an awful lot of leases, even though there's a million rows and X thousand columns in Excel workbooks, it starts to stretch the capabilities of Excel, shall we say. So there is a pitfall of Excel hell. Another one that you may not have thought of is if within your business you've got people who are rewarded based on their performance, and that's assessed against their EBITDA level, all of a sudden they're going to get more bonus, because you know what, the EBITDA has been improved because the leases have been taken below the line. So again, you need to just start thinking about, are there any performance payments that we need to adjust for this change in accounting that we've got. So that's a few of the pitfalls. And the key bit, I suppose, the big take before I hand over to Chris is, I keep mentioning about data. I mean, keep mentioning about volumes, keep mentioning about understanding your estate. And that is, if nothing else, is the biggest takeaway. You need to understand all your leases, you need to understand your embedded leases, and you need to make sure you tee it off with your accountants, so that you minimize your conversations, and certainly conversations year on year. So hopefully that's set the scene for you. Hopefully that's given you a few things to think about. And now I'll hand over to Chris, who can hopefully take you through how Tagetik's been used for a lot of customers across the world to help with IFRS 16. But I don't want to steal his thunder, so I'll hand over now, and then over to you, Chris. Thank you.
Thank you very much, Nick. This isn't a sales pitch. This is a masterclass webinar. I promise you, there's not a logo slide coming up with all those logos on. But if we've got relevant cases as we're discussing for the next 40 minutes or so, we'll try and bring that to life a little bit. I know at the poll at the start, I think exactly where we would have anticipated those votes to come is where they come in those middle brackets of, look, this is new. We understand the challenge, but we need to understand a little bit more. And I think a lot of what Nick said, probably on that pitfalls page in particular, really highlights the challenges that any change in accounting standard kind of brings to us and brings to our desk. And we understand that always tends to bring a little bit more workload. The Excel piece is a crucial one, and we'll touch on that a little bit when we start to look at how Tagetik can help. Because we don't run away from Excel. My first approach after reading white paper after white paper back in 2018 on this, when IFRS 16 incepted, was to build it in Excel myself, because that's what made sense to me. That was my first approach. At the Q&A at the end, if someone's asked a question, I can tell you the 10, 20, 30 problems I came up with, and a lot of that was how it evolves over time. A simple asset equals liability calculation is fairly simple. IFRS 16, to go back to, I need a little more clarity at the start, brings in the key accounting principles we know that come with assets, fixed assets, and capex. It's present values, it's depreciation over the life of a lease, understandings of impairment and provisioning for onerous leases and dilapidations. All these things still exist, and actually it's a great one for a young accountant to start to understand the basics of double entry. But doing that 2,000 times over on a moving estate is tricky in terms of data volumes, and we'll look to touch on that as we bring this to life. But if we step into kind of the first slide then, that gives you an idea of who Tagetik is, and like I said, this isn't going to be a huge sales pitch, but I think the understanding of what we do and the approach we take, I think is core to understanding how the solution helps. So CCH Tagetik is a full end-to-end finance platform. So from a legacy perspective, it brings those kind of consolidation, financial planning, and budget functionalities to the market. Within that singleized platform, and now within the extended intelligent platform encompassing AI, we can use those functionalities to deliver value on the regulatory end of things as well. So IFRS 16 has been around since kind of 2018, 2019 from our perspective. But it doesn't just touch that. I mean, from a lease accounting perspective, we also look at US GAAP, we look at UK GAAP, obviously, with FRS 102 that we're discussing here. But there's also things around corporate tax, ESG, a little bit around IFRS 17, and each time a new standard now kind of steps in, Tagetik looks to step in to see how we can breach that. And if we look at this platform, the reason why it's key is it pulls on those functionalities, key things around kind of FX, around modeling, around calculation power that we know exists elsewhere. We can harness that to help us on the regulatory space. And if we then take a little step into kind of the next level here of the platform, we can then see the breakout of the different areas on the next slide, which I think that will kind of then show us where this helps. So the big thing I want to kind of touch on here is that regulation isn't new to us. It's something that we've been incredibly successful in for a long time and help an awful lot of businesses kind of approach their regulation and stay up to date with the standard. The reason why I think that's important is we're not looking at point solutions. We're not looking at third-party developed assets. As much as we enhance our third parties such as HAYNE to come to the market and add value to our customers, these are in-house developed, delivered and supported products. So as I said, lease accounting has been around since 2018. It still has a dedicated product team, still has a dedicated support team. And I think we're on nearly release 30 now. So the advantage of FRS 102 kicking in 6 years later is the inception pain's been felt by organizations before, and actually those developments over time, which I'll touch on, where they sit in the product, have been there and done. So that's just a bit of a background in terms of where we are as a solution, real headlines, and kind of why regulation works for us. And it's something that, like I said, like kind of Sophie said in the beginning, something that I've been living and breathing for the last 7 years. So then if we step through to look at how that process flow works. So like I said, I want to try and bring the step-to-step calculation to life. This is the flow of your data. This is how Tagetik works, but actually it probably is how it needs to work no matter the approach. And like I said, this is an overview into lease accounting, not just into how we're doing Tagetik. So Tagetik has end-to-end integration capabilities. So integrating with nearly any data source you've got either end. So your ERPs, lease accounting, kind of solutions, we've got kind of fleet solutions, property solutions, whatever you've got, we can connect to it. So we can bring in that contract information from external sources. Alternatively, and realistically from a day-to-day perspective, I will touch on in a second, data entry by look and feel Excel forms and Excel template uploads, where we provide the template, you paste in your data, and we upload that. And those key pieces of information that we need to consider to get any kind of result out for IFRS 16, FRS 102, ASC 842, contract dates, key contacts, contract info, the type of contract from kind of an operating perspective, kind of the activity of the lease, where it kind of sits, any payment rules, interest rates, associated impairment, any options you've got on the lease, break clauses, any kind of provisioning. All of these things need to be considered over across dates, times, frequencies, and need that input. And in reality, a lot of that information exists in contracts. And then we apply our, as Nick said previously, the interest rates, and we kind of go from there. So all of that information goes in either via external source, Excel upload, or data entry form. We then run our calculation engine over it. The calculation engine is configured by an Excel front form, essentially, where organizations tell us, right, this is how I do my depreciation, 360, 365 approach, flat 12 months or a daily. February has a lighter weighting than January, it has less days. Same from an interest perspective. How do we want to deal with kind of impairment? What's my calendar type? So deals natively with retail calendars, fiscal calendars, etc. Kind of the different ways in which we want to look at exemptions. So as Nick said, the low value short-term exemptions that we can apply, but also things such as thresholding on expiries. So little then tips and tricks that allow us to manage our lease estate as well. So one of those as an example is we can say from a lease perspective, 6 months out before the termination of any lease, let me know, change it to expiring. That then allows me to be a true business partner, return back to the business and go, right, in the next 6 months, here's all the contracts we've got coming up for renewal. And that can be fleet, property, wherever, and we can send that around and really add value to the business. We're not just having to look at this from a true standard perspective. Those calculation outputs come out in the form of an asset plan that we'll take a little screenshot of in a second, and they then drive our journal entries and our double entry that is completely configured based on those outputs at a very, very granular level. If you have multiple ERPs, multiple account structures, from a global, regional or entity perspective, they can all be handled in the system and automatically come out in calculation. I mean, we'll get onto data volumes in a second, and we'll talk about kind of the timeframes to process and output. As we've touched on then, they'll bring out payment schedules, asset plans, journal entries that allow us to report. And that reporting out the box as a standard come all your standard disclosures, but then the ability to add management reporting, decision reporting, forecasting, approval workflows, and the integration of Power BI as well. An awful lot of organizations we know have a Microsoft first theory in terms of tech, and so we integrate natively with Power BI, a direct connector that allows live reporting of your data as well. Then from a journal entries perspective, we can look at then bringing those integrations, as I said at the start, directly into your ERPs, directly into kind of console systems, or Excel outputs that allow kind of that manual upload. So there really is flexibility in the process. We can always give advice on best practice, but the true practice is everybody's doing it differently, and actually it is all about business culture and what fits you best. If we then take a look then at kind of the next part, which is what does a process end-to-end look like, and what does an implementation look like on the next slide. So when we look at this, along the top just gives you an idea of what a month looks like really. Copy your leases, calculate them, add any new ones, modify any, review your outputs report. It's fairly straightforward. Depending on what your add and modify part is in the middle, if you've got a large build kind of from a manufacturing perspective, or maybe like a large property portfolio, that middle part might not move that much. Fleet moves an awful lot more. People tend to crash cars, unfortunately. But that piece in the middle means that you might literally have to press 3 or 4 buttons in your process. And that then makes life an awful lot easier. If we just step down then into kind of the implementation and the first running, the way in which this looks in a typical state from a Tagetik perspective, upload all your leases using an Excel template, copy and paste from the data sources that you have. We'll run the lease accounting engine over them. We take a little look, see what's kind of under the hood, if we need to make any modifications, review and reconcile those outputs, and then we're ready for first reporting. It is pretty much that straightforward. The massive advantage, as Nick said, with the kind of experiences we've been given with FRS 102, we essentially don't care about the past. So we can start from day one, as long as our lease data is correct, the calculation engine's correct, we're ready to go. The longer we delay, the more reconciliation we have to do, because we have to recognize modifications in real time. So if we kick off in January, like the majority of organizations will, we'll then move through, take our leases forward. If we've got then modifications in March, we need to recognize those in the accounts in March. Same with April, May, June. So if we don't look to go live until December next year, there's a whole year's worth of reconciliation and modification have to be done sequentially to ensure those outputs are correct. So this really is a here and now item. I can talk from an awful lot of experience of doing this through 2019 and 2020. It got more and more painful. And actually, the moving parts of getting the information from a finance perspective from those teams that kind of live and breathe, the fleet, the property, etc., the kind of manufacturing operational teams, that is probably the trickiest part. It's staying up to date. If we've then got to go and find that retrospectively, it massively elongates the time for calculation, the time for being able to get kind of comfortable with this. So no matter your approach or how you go about this, time really is of the essence. I've kind of run through anyway what the business as usual item is, but one key piece that I think is really a massive advantage with Tagetik, and it's some of the auditability that it gives us. It will give you an output every single month of your leases. So it gives you a version of the leases as they were at a point in time every single period. So when we say copy leases, it's a one press button, the solution, but that will then take all the leases as they are this month, paste them into next month, so January to February. They're now exactly the same, showing you the same outputs, giving you the right journal entries. You make your modifications and additions, they then sit in February, and you can see the difference between the two. So what this allows us from a kind of audit perspective is to show the auditors the exact kind of trajectory of those leases. It'll also allow us to make retrospective changes that I'll start on in a second, which means that our reporting and our ERP always match. We don't end up with these off-book transactions. We don't end up with these off-book calculations, which frankly give everybody a headache, yourselves, the auditors, etc. So let's get a little bit of a look and feel then of what the solution is. So this is a version of the homepage. This is very much my Blue Peter moment of one I created earlier. So this here then shows you what a production version of the solution looks like. And as we go through, an awful lot of what you see is the starter kit. So actually this would be a blank homepage. we would add what you want here. It's a drag and drop. You'll see a new widget button just in the top right of that screen. Click that, you add what you want. It's very, very simple. But actually, from this perspective, you can see we've got guidelines to our reporting, our contract and review jumping in our workflow down the left. We've then got an embedded Power BI dashboard showing us our lease data in the front. That could be anything, at any kind of part of reporting that we want. We can also include dashboard in other report links, but I think the Power BI stuff always gives a really, really nice look and feel. It's something that's very similar to what we see on a day-to-day, and I think that's the key piece with Tagetik, is keeping that kind of consistency on the day-to-day basis. If we then jump in to look at the workflow on the next slide, we'll then see, as we come through our process, down the left-hand side is our organization structure, likely an entity structure, but can be anything, cost center, it could be geography, whatever chooses or works best for your business. And every single one of those can have a different workflow. So quite often we group them. The entity level, the lowest level, has one workflow. Then we might have kind of a segment of a business, the next, and then the company group's different at the top because they have a little bit more kind of power. But actually this workflow then is the same that runs through. And what we can see here is exactly what comes out of the box. So day one, even before a consultant touches it, that is what it looks like. And exactly that process I've just run through. First button copies the leases forward. Next one's a mass upload, a calculation. And then we go through to manage and modify or create. So then if we jump in to look at the next screenshot, we'll then see what a manage and modify screen looks like. In here, it's a list of all the leases down the left-hand side, depending on the entity that you was just on. So if I was just looking, I think Rome was the one selected from the workflow, we can now see a big list of our leases. We can see kind of key contract information in here. KPIs and visuals at the top are all bespoke, so exactly what you'd want. They can be brought in. The look and feel of this is built in Excel. So that comfort of Excel that we mentioned before, the look and feel is the same. It's built in with an Excel add-in. So actually all of these can be moved around using those features and functionalities. I would then select a contract code down the left-hand side, and that would allow me to look at the contract, which we'll just take a little look at on the next screenshot, which then has all of our key lease information in it. So if we could jump forward to the next slide, please. Fantastic. Here we've got all the key information. So on the left, it will highlight all the mandatory information that you have to do, completely selected by yourselves, bespoke to whatever you want as an organization. Contract code's mandatory, a couple of descriptions. Contract status is active. As I said, that will be set to expiring based on a threshold that you kind of want, and the system does that for you automatically. We then set the dates, kind of interest rates. In here also, we've got the ability to exempt based on the system does the automatic exemptions for us, but if we want to exempt on a spot basis, we can. Impairment information, fair value, sale and lease back, all of those things that we know and I will say love, but yeah, we can put those in here. A really key piece of information that I'll touch on is something called recalculate from scratch. What this allows us to do is retrospectively recognize modifications. And I think it's probably one piece of functionality that will stand Tagetik out against anything you look at in the market. I still believe we're the only ones that do it. The ability to say, I'm in June as an example. Now, I'm in October, it makes sense to pick that month. I'm in October. There was a change that was made in June, but I didn't recognize it. Fleet forgot to tell me that they crashed 5 cars and they need to de-recognize them. What I can do is make that change, tell the system I should have made that in June, select an option that says recalculate and write off. It will then provide the write-off journals for the 4 or 5 months that I shouldn't have recognized. It will then give me my catch-up journals and post them all in the same month. What that then means is my ERP will exactly match the auditability that I've gone to Tagetik. So my auditors ask me about it, I can show them the exact process that I went through. And so it is really, really clean. And also you don't have to work it out yourself, which is probably the biggest benefactor there, if I'm completely honest. Exactly the same with leases we don't know that incepted. So I could have incepted a lease in Jan, I didn't know it's now October, recalculate from scratch, gives you my catch-up journals, recognize it for me. It can also go through and show you kind of key things I think we're looking at in terms of the drop down. So this is all drop down driven. It's not kind of keyed in data entry. You don't lose kind of control of your data at all. If we then look at the payment rules, you can see I'm probably picking this up. Normally you can do a demo in about an hour. I'm trying to get through these in about 15 minutes. But from a payment rule perspective, exactly as you'd expect, rent, the dates in which you're paying them. We cover any kind of payment rule you can think of, even kind of non-capitalized items such as service costs that we might want to manage and analyze of our leases, but yeah, all your kind of provisions, incentives, transition accruals and prepayments, renewal, termination, purchase options, which can be put in on a certainty basis. So if you know you've got them in a contract, I've got a termination option in 2 years' time, but I don't think I'm going to take it. I said it is not reasonably certain. Accounting principles of certainty means we don't recognise it. 6 months' time, I think I'm going to recognise it. All I do is I change that drop down the system. It then recognises it for me. So really, really simple kind of movement of kind of the options. Some auditors want to see the risk of your options too. So we've seen, I've got a couple of examples. In fact, Nick, we were talking about this before. At Centrica, they got asked, we want to see the risk if you took every single option or didn't exercise your options. What are the risks in your fleet base? So all of a sudden, then we had to come up really quickly with a way of doing that. If you did that in Excel, one, you'd break it, and two, I just don't know how long that would take. If we then jump through to take a little look at the outputs then that we've got, asset plan will give you the full calculation of the full lease every single month. So it would show you those retrospective changes, but gives you a full walk. So our calculated present values down the left-hand side, and it shows you it step by step. The interest we're applying, which is our liability open, asset equals liability, and then our variation by month, which is minus payment plus interest to give us our close. Any adjustment for mods, as we can see, would be in those, and exactly the same for the asset side. Open asset, depreciation, derecognition, subleasing, embedded lease movements, impairment, close. Same for your depreciation. So this is the gospel of each lease, and actually it's something that you would actually know and love going through a project, because it really does show you that. This goes down to payment rule level. So this actually goes even further than this. Every single payment rule you have, a termination option, rent, incentive, would have its own version of this. So we can go down to that level in terms of granularity of reporting, but also granularity journal entries, which is the last screenshot that we'll just look at now, which then takes all the numbers from here and puts those in your double entry. So then it figures out all your double entry based on, and it gives you the clues down the left in terms of what it's doing. So you can see here, it's doing it for rent, asset creation at the top, liability and asset payments to create my opening asset and liability, and then all my depreciation, my cash, my P&L and balance sheet movements then. And it will show you for the full life of the lease. And then we just extract the ones on a monthly basis. I'll try and just summarize all of that up into some of the key learnings. Nick touched on this at the start, and it is crucial. Data, data, data. It is going to be the biggest nightmare of this transition is data. It's finding it in your organization to start with. The amount of customers we had that would come to us and say, oh, great, I found out there's a load of cars I didn't even know about. Or, yeah, there's properties we aren't even looking at here. So just finding your leases first is the main one. Where's the data sit? Who owns it? Who's going to tell me when it changes? There likely isn't a central repository. And that's something that we found constantly. Same, I mean, the interest rate's far easier with FRS 102, and I'm very happy about that, because that'll be far easier for everybody. But there's also internal business things that we need to consider. Chart of accounts extension. I would nearly guarantee most of you that haven't considered this don't have the right accounts to take this on in January. You won't have the asset accounts split by asset classes, and then the different movements that would need to be captured in the ERP to be able to report this effectively. So there is an ERP extension that's required, account creations, and there'll be internal processes that you will all know as well that you might have to go through to be able to get those ready in time. How are you going to process this? It's a brand new process, but from a group perspective, those that aren't just a single entity, are you going to have a centralized or decentralized process? Are you going to ask your entities to do this and report to you? Are you going to manage it yourself? Because just understanding that would really define how you're going to approach this. Going back to the top point, data, 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 if you're going decentralized, it's far easier from a day-to-day perspective, but then managing all those stakeholders to bring us together brings a huge challenge. And the final one before we jump into some questions is auditability. So we looked at kind of Tagetik's auditability purposes and how that has really evolved over time. Come from a forum that we did in a poll after the first year of disclosure from an IFRS 16 perspective, and we asked our 40 odd customers in the UK at the time, I mean, from a global perspective, way over 200 now. How did you get audited? The 4 buckets we selected, it was 25% in all 4. Basically, the auditors weren't prepped for it. they were guessing a touch. They knew the standard, but they didn't know how to sample this, which meant that it didn't give us consistency how we needed it. So we just needed to go as granular as possible. Some would go lease by lease and count it through. Some would just tick off the fact you did it. And actually, there was a real disparity in how that's done. From a larger audit perspective, your big fours, etc., they've probably been living and breathing this for a good few years. If we're starting to look at kind of smaller localized firms, this is going to be new to them as well. So actually, we need to have a little consideration on how well we're prepping ourselves to be able to approach that audit piece in what, 15, maybe more 18 months time. I think that is probably a slight overrun, but all from me.
Thank you very much, Chris. We'll now move into the Q&A part of our session, and thank you to everyone who's already sent in questions so far. Please keep them coming using the question box, and we'll cover as many as possible as we can now. So going straight into our first question for today, the first one is for you, Nick. I've got the question here. Are there particular industries or sectors that will feel the impact of IFRS 102 more significantly?
IFRS 102, yeah. Well, although all businesses are impacted, so it's hitting everyone, that those with a propensity to lease assets are going to be obviously more impacted. So you're thinking of your manufacturing, your construction, your logistics industries, and Chris touched on earlier that, you know, the maintenance repair businesses, those businesses have got large fleets of vehicles. So you mentioned Centrica, you think of how many British Gas vans you'll see on the road, etc. You know, they are going to be massively impacted. So yeah, those four are probably looking at more impact than others, but it is everyone. You know, sadly there is no escape from this. It's got to be done. So it's everyone, but those manufacturing, construction, logistics, maintenance, repairs are probably more than other industries.
Brilliant, thank you.
Just tell very quickly to talk around these volumes of some of those examples as well. So in some of those upper ends, we're looking at 20 to 30,000 leases in some of those examples. Extreme cases, but that's the data volumes in which we're handling it in some of those kind of key manufacturing examples. Yeah, just one other point on there as well. Even if you don't have a large volume of leases, if you have complex leases and leases over a long period of time, you know, 100-year leases or whatever you've got, all of a sudden that then becomes complex. That becomes a lot of data you're talking about, because you're going to or will need to understand the tail of the lease. So even if you've got 50 leases, it can still be a big problem for you.
Brilliant, thank you very much both. And for our next one, this will be staying with you, I reckon, Nick. What challenges do companies typically face when transitioning to new lease accounting standards?
Interesting, probably what we've talked about already, certainly what Chris had both mentioned, is the data. Understand your data. That's what your biggest problem is. Once you've got a grasp of your data, then you're in a position to start your conversations with your auditors. You know, so get an understanding of your lease estate, get an idea and understand your strategy. How are you going to deal with it? Are you going to do it and feed back into your ERP? Are you just going to do an adjustment to your extended trial balance at the highest level, at a group level? And even if you're a single entity, you know, do you want your ERP to reflect these adjustments? And if you do, as Chris said, you've got to start looking at your chart of accounts, make sure you've got the right accounts in the right place, that they're aggregating to the correct level. So there are considerations there, but it's just getting to grip with the data, being in a position that you are then able to talk with confidence to your auditors. As Chris said, they don't necessarily understand it now. It's new to them as well. If I use going back into my misspent youth, I did the migration to IFRS 3239 for Barclaycard many years ago, in fact 21 years ago, 2004, and part of that was going through with the auditors of what the changes meant, and to be honest, that was as much a teaching exercise for us as a conversation. You know, teaching the auditors that were coming along of what these changes meant. We understood it because we've been living it for 18 months, 2 years, but for some of them it was new. Certainly the audit juniors. So it's a case of, yeah, don't think just because they're auditors they'll know all about it and understand it fully. There is that education piece, but it also then means that you may be in a better position to direct how the audit goes, depending on your relationship with the auditors.
Brilliant advice. Thank you very much, Nick. We have another question here, and Chris, I'm going to turn to you for the next one. So this question asks, what are the key benefits of using CCH Tagetik over manual spreadsheets or other systems for lease compliance?
In terms of spreadsheet, I mean, definitely availability of data, auditability and ability to report on data and on your leases, understanding your position and speed to calculation. I think managing any kind of modification is a nightmare. I'd challenge a few of you to do it on a singleized basis, let alone on tens, hundreds, thousands of leases. It is, yeah, very, very difficult to manage. I think the functionality of kind of retrospective adjustment, the kind of automation pieces that I think Tagetik provides fantastic in terms of, yeah, we can do kind of indexations, simple break clauses, kind of interest rate matrices that automate your process for you, which take what is added workload to everybody. That there's no one here, I think, that is like, do you know what, I've got an extra day and a half a month that I can scrape out for this. It's incremental. So actually make that as painless as possible.
Yeah. And just a thought, Chris, on the horizon, I know there's always a roadmap, and you mentioned earlier that it's constantly been developed, the system, and there's a dedicated development team in Italy that are constantly looking at this. But I know there's certain AI functionality coming along on the roadmap that will help understand and interrogate your lease estate.
Yeah, I mean, across the platform, we've got a number of pieces of AI technology, but specific to leases, we'll be looking at kind of ask AI functionality, the ability to essentially ask a question. I don't know how many of you have migrated to Copilot or are you already using AI chatbots, but the ability to do that in tool and say, right, what's my lease kind of liability for this month, and the ability to then graph that as an example, that is something that we will be seeing in the very near future, and especially from an FRS 102 perspective, it will certainly be here before yeah, we need to disclose.
Thank you both. Our next question, I'm going to open this out to the floor. So how do we ascertain the interest rate to work out the present value of lease liability if we don't have this embedded in the lease agreement? So any thoughts on that one?
It won't be in the lease agreement. It's probably the simplest term. Nick said, I mean, you may want to add to this, but from experience, nearly all organisations I've worked with are applying their internal weighted account to cost of capital. So that's an internal kind of metric that will be somewhere in the business. It is necessary, and you can apply that, and that can be applied on an annual basis. So the other thing to remember with this is that on modification, say you extend the lease, you need to reassess the interest rate. So you need to go back to the business and say, what is that interest rate? From a Tagetik perspective, you can put that in the system on the 1st of January, and then it will just associate that for all the new leases and changes. But Nick, I know that there's a certain, you don't have to do that under FRS 102, do you?
Yeah, absolutely. So there is a concept that's been introduced by FRS 102 that's not there in IFRS 16, and that's around different. IFRS 16 looks for incremental borrowing rate. What's the incremental borrowing rate for the business at that point in time? Whereas 102 is slightly more forgiving, shall we say, and it just asks for what's called an OBR, an obtainable borrowing rate. So what rate could you get in the market for that type of asset? So it does allow that bit of flexibility and slightly less onerous on evidencing where you've come up with that rate. You can go and say, well, actually, if I was taking this lease, today it would cost 4 points above that base rate or whatever it is, and as long as you can evidence it, then that will allow you to have that conversation again, going back to the auditors saying this is where I've got it from, this is why I'm calculating at this rate. So it is the difference between OBR and IBR. I think FRS 102 is that slightly more flexible there.
I think going back to the poll, there's a few that were saying I need more clarity on kind of the migration to the kind of new lease accounting standard. It's as simple as how you'd calculate a mortgage or finance on a car. It's exactly the same. So yeah, in terms of figuring out that interest and the liability element, and then from a asset side, it's just whatever that present value is and depreciate it over the life of the asset like you would any other asset. So yeah, if you can figure out mortgage, you can figure out FRS 102, which probably made it sound more complicated, but it is simple enough. Yeah.
Thank you both. We're coming towards the end of our Q&A session, but we can take a couple more questions, so please do keep submitting them. And if we don't get to yours today, don't worry, we will follow up with you directly afterwards. But just to take us back to our next question, and I'm going to come to you for this one, Chris. So we've had some organisations go live in as little as 4 months. How does Tagetik support such rapid implementations without sacrificing quality?
Yeah, so the product's robust enough that the starter kit's kind of enough. So the way in which we would do that is we'd say, what's your financial calendar? Don't even really need your chart of accounts to get the numbers out, but we can then say, what's your entity structure? Where's your lease data? If that's structured, plug it in, set the rules, press play, and we go. It is that straightforward. The quickest one we've ever done is 11 days consulting time, which was about a month. Maybe we wouldn't take that one again, but I think 4 months is more than fair for reconciliation, discovery, data finding, because we've got a bit of a discovery period here at the start as well. We've started our FRS 102 journey already, and we've had projects kick off in late August that will go live in November.
The one thing I'll add to that as well, from not just IFRS projects but CPM projects as well, is there's always a temptation to give the task to someone to put on the side of the desk, and they'll do it alongside their BAU activities. The problem is the first thing that falls off the side of the desk is the project work. As the CEO comes in and asks for another set of reports, and I'm guilty of that all the time. So that takes priority, and your project work gets kicked back. And yeah, if you have the luxury of backfilling someone just to focus on this, I would advise that, you know, invest in it, get the project up and moving as quick as possible, and using someone internally within the team, because then you've got the knowledge share. It's retained in the business, and we certainly, our approach is always share as much knowledge as we can, because what we don't want to do is have a scenario where you have to keep coming back to us. As much as it's great from a revenue perspective for us, we don't want you to come back, you know, things that small or medium changes should always been able to do by the finance team. It's only where it's a really large change where there's a lot of complexity that you should ever need to engage with us.
I'd add one final point as well. We don't have to go big bang. We don't need bells and whistles. So we can have those, but there is definitely a piece of looking to get an MVP here, which we would call a minimum viable product. Let's deliver something that's going to do what we need to do. We can add reporting, we can add automation, we can add an internal workflow, we can add an approval process, but let's get our standard out first. So we can also do that and look at a far quicker first piece that gets us where we need to go, and then add throughout the year, because as we said, the earlier we start the calculation, the far easier it is on the teams as well.
Brilliant. Thank you both very much. Some of our final questions that we've had coming through are actually around what preparations can businesses take now to prepare, and how can they get in touch. So without further ado, I suggest we move on to the final part for today, and hand over to you, Nick, to talk us through those 4 final practical tips to help avoid any last-minute pressures before January. So over to you.
Okay, thank you. So what can you do? Deadline dread, which is always a good expression. We keep saying it, understand your lease estate, including your embedded leases, understand what you've got, start looking to get the data together. You know, we keep going data, but that's what it is, you know, get your data. It's a big push, but once you've got your data, as Chris said, we can get minimum viable products, we can get calculations working, we can then further down the line sort out the glossy reports that you need to go with it, but just start getting your data there. Understand where you want the adjustments to go, understand your strategy. You know, are you feeding it back to your ERP or just doing it at your final reporting level? I'd personally always look to put it in an ERP if I can, because that's what's going to get audited. That's where your auditor is going to tick and bash and green pens, as they see, or certainly used to love in my back in the day. But yeah, make that decision, because you can choose. It's what's appropriate for your business. We keep saying about, do you do it in Excel or in a system? Well, make that decision early. You know, if you're going to do it in Excel, that's fine. There are pitfalls for it. We've highlighted those. But again, it's about volumes of data. Understand your data. Understand whether actually a system solution is going to be better for you. And in some cases, if you've got one or two leases, probably not. But where you're starting to get a lot of data, then you need to start thinking about, how can I systematically do this and future-proof it? And that's the key bit. Get your future-proofing in. And finally, as always, give us a call if you want help in setting this up. Speak to us. You've got contact details, and we can help share our experience of lease accounting. Work with Chris quite a lot, so we can get experience from the wider Tagetik team as well. So I think this IFRS 16 has been installed in something like 320 different businesses around the world. Most issues you'll face will have been faced by someone else there. So we can bring that experience to bear. So please get in touch. Email addresses there for myself, Ian, and Nafis within the HAYNE team, and we'll be delighted to talk to you and discuss how we can help.
Thank you very much, Nick. And that brings us to the end of today's Lease Accounting Masterclass. So we hope you found the session useful and it's given you the confidence as you prepare for the upcoming changes. For more information and to explore how HAYNE Solutions and CCH Tagetik can help put the ease back into lease accounting, please reach out to a member of our team using the details on your screen, as Nick has already said, and we'd be absolutely delighted to help. Final thing to say today is thank you all for joining us, and we really look forward to hearing from you soon. Thank you.
Thank you, guys.
Thanks, everybody.